Mutual funds can quickly diversify your portfolio. Here's how to choose and buy mutual funds. Retirees and long-term investors like mutual funds. Mutual funds allow investors to buy a variety of assets. Mutual funds pool investor resources to buy stocks, bonds, and other assets. Most investors develop a more diverse portfolio with mutual funds. Index, bond, and target date funds are mutual funds. Mutual funds are mutual because investors share equally in the fund's gains and losses but do not own its shares or other investments. Why invest in mutual funds? Mutual funds are a low-maintenance way to invest in hundreds of stocks, bonds, and other assets. Mutual funds are popular with investors who want to benefit from the stock market's historically strong average yearly returns without selecting individual investments. Active or passive management affects mutual fund expenses and performance. Passively managed funds invest to beat benchmarks. They try to mirror a market index like the S&P 500, so they rarely need specialist management. Due to lower overhead, passive mutual funds sometimes charge less than actively managed funds. Passive mutual funds include two major types. Index funds are made up of equities or bonds on an index, so their risk and returns resemble that index. If the S&P 500 is up 3%, your index fund should be up around the same. ETFs are traded like stocks but offer mutual fund diversity. ETFs offer lower minimum investments than index funds. ETFs may be taxed less than index funds. Professional managers or management teams make investment decisions for actively managed funds. Studies demonstrate passive investment strategies outperform the market or benchmark index, which they often try to beat. What is the best strategy to invest in mutual funds? Start investing in mutual funds with this step-by-step guide. Choose active or passive. The initial decision may be the most crucial. Outperform or mimic the market. The decision is also simple. One technique is more expensive yet generally yields inferior results. Some fund managers may do this in the short term, but long-term market outperformance is difficult. Passive investment is becoming more popular due to its ease and potential returns. Active investing costs more than passive investing. Consider your budget. Two approaches to decide how to proceed are: what do mutual funds cost? Mutual funds offer the seductive option of choosing how much to invest after meeting the minimum investment level. Mutual fund minimums range from $500 to $3,000, but some are $100 and a few are none. Thus, if you put $100 in a fund as a minimum, you may be allowed to contribute more or less in the future. A mutual fund with a $0 minimum may allow you to invest $1. After the initial commitment, decide how much money you can comfortably invest. Which starting fund combination suits you? Younger investors have more time to ride out riskier assets and market downturns, so they may prefer higher risk choices. Target date funds automatically rebalance your asset mix as you age, eliminating the "what's my mix" question. Investing in shares requires a brokerage account, although mutual funds offer options. If you contribute to a 401k, you're probably already invested in mutual funds. You can buy directly from Vanguard or BlackRock, but this may limit your fund options. A normal financial counselor can help you get funds, but it may cost more. Most investors buy mutual funds through an online brokerage, which offers a variety of products from different fund firms. Mutual fund investors may pay brokerage account transaction fees, cost ratios, and front and back-end sales loads from the funds. Only a dozen mutual funds may be in employment retirement plans. Some brokers provide hundreds or thousands of no-transaction fee products and ETFs. Choose a broker who will help you research a fund before investing. A brokerage's website or app is useless if it's confusing. You want to understand and feel comfortable. No mutual fund fees. Both active and passive funds charge an annual fee for fund management and other running costs, expressed as a percentage of your investment. A 1% expense ratio fund costs $10 for $1,000 invested. The cost ratio of a fund may be hidden in the prospectus, but it's worth learning because these costs can eat into your gains over time. Mutual funds have several cost-affecting structures. Most mutual funds are open-end, with no investor or share limit. With the fund's value, the NAV per share rises and falls. Closed-end funds. Like firms, these funds offer a limited amount of shares during an IPO. Compared to open-end funds, closed-end funds are scarcer. Closed-end fund prices are quoted on stock exchanges all day. This price may be higher or lower than the fund's value. Fund commissions are denoted by loads. Load funds pay a commission to the broker or salesperson who sold the fund, which is passed on to the investor. No-load mutual funds, also called no transaction fee funds, charge no sales fees on fund shares. This is the best value for investors, and TD Ameritrade and E-Trade offer thousands of no transaction fee mutual funds. Most no-load funds are available to individual investors. After choosing mutual funds, you'll need to manage them. Rebalancing your portfolio annually can help you stick to your diversification approach. If one of your assets earned huge profits and now accounts for a larger share of the pie, you might sell some of the gains and invest in another slice to restore balance. Following your plan will also deter performance chasing. Fund investors and stock pickers who want to invest after hearing about a fund's performance last year face this danger. However, past performance is no guarantee of future performance, is an investing cliché for a reason. It doesn't mean you should invest in a fund forever, but performance rarely works. Other than active and passive, mutual funds have several classifications. Some mutual funds concentrate in stocks or bonds, while others diversify. Stock mutual funds, equity funds, often have the biggest risk and potential profit. Equity fund returns can be affected by stock market volatility. Equities are divided into growth, income, and sector funds. Every group keeps a portfolio of stocks with certain attributes. Value stock funds invest in undervalued firms based on fundamentals. Balanced funds hold a mix of stocks, bonds, and other instruments. Balanced funds, also called asset allocation or hybrid funds, are often used as fund of funds, investing in other mutual funds. As you near retirement, a target date fund automatically chooses and reallocates assets to safer investments. The combined funds consist of a combination of value and growth stocks with high profit growth. Fixed income bond funds are often less risky than equity funds. Because there are several types of bonds, you should evaluate each mutual fund's risk separately. Mutual funds in the money market sector often offer the lowest returns. Money market funds must invest in high-quality, short-term U.S. government or corporate investments by law. How are mutual fund profits calculated? Mutual funds offer three strategies to grow money. Investors receive a percentage of a fund's dividends or interest from its portfolio holdings. When you buy mutual fund shares, you can receive distributions immediately or reinvested. A fund makes a capital gain when it sells a rising value investment. A fund incurs a financial loss when it sells a falling-priced security. Most funds pay investors annual net capital gains. In a year with big capital gains distributions, investors, especially high-net-worth people who pay greater capital gains taxes, may pay a lot. Mutual fund share transactions are finalized after the market closes and asset values are confirmed. The price per share of a mutual fund is its net asset value. The fund's worth increases the cost of buying shares, net asset value per share. Similar to when a stock price rises, you don't get immediate dividends, but your investment appreciates and you benefit if you sell. Do you think mutual funds are right for you? There are always tax considerations to make that vary for everyone. Leave a comment below describing your mutual fund investments and how you manage your taxes. Don't forget to like, share, and subscribe. Hit the notification bell so you'll know when the next video posts. Take care and remember that your money matters.